Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the money supply, or M2. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. In this video, we are going to look at the money supply in a number of different ways. We're going to first look at the raw data and look at the year-over-year percentage change, maybe even look at it on some other time frames as well. Then we're going to look at it in a different way, and that is to adjust for inflation, which I think is it opens up some insights that you will not get if you ignore inflation. So I want to go through this fairly systematically. I think there is some confusion on Twitter on how to read some of these charts and the ramifications of what it means or what it doesn't mean. So let's just cover everything as best we can. All right. So essentially what we have here is we have M2, the money supply, which is the orange line. The blue line is the S&P 500, and that's just there for your reference. I'm probably not going to talk much about it, but as we go through the charts, you can see where the S&P is. And then these gray shaded regions are recessions, right? Now, clearly, all recessions are not brought on by changes in the money supply. I mean, it's obvious. They're normally brought on by, the unemployment rate going up or something like that. But it's just there so that it's just there for your reference. Okay. Now, the money supply, in this case, we're talking about M2. And the way M2 is calculated is essentially M1 plus near money, which is savings deposits, money market securities, and time deposits such as CDs. We talked about CDs before, certificates of deposit. This is, we've talked a lot about in fixed income investing. As rates have gone up, it's opened up different types of investment vehicles for millennials for everyone, but right, millennials haven't even really seen these types of investment options because interest rates have just been so low for so long. But now they've gone up a lot, and so more people have gotten CDs. So it's M1 plus all that stuff, and again, M1 is the M1 money supply includes currency, demand deposits, and other liquid deposits. So when we think about M2, we can think about it would generally expand, right? Like you would generally think that as the economy grows, as there's more people, we would expect for the money supply to generally expand. If it were going down, then you would have to start to wonder, well, how is that going to affect, prices of things? If the amount of money in circulation is going down, what would that do to the prices of goods and services and risk assets, right? How would that affect things? And the reason why that's important is because, in 2020, when the Fed printed $6 trillion, we saw asset prices go up a lot. But we also saw asset prices come down a lot in 2022, and some have been continuing to come down. I mean, many have put in new lows even as recently as this week. Depends on what sector you're looking in. But it's important to understand, what are the ramifications of the money supply going down. So what I want to do is, first of all, if you look at this chart, you'll see that this is the first time, at least going back to, say, the 1950s, that M2 has gone down, right? Now, is it the first time ever? No. There have been plenty of periods in history where M2 has gone down year-over-year percentage change, just not that we have at least supported on this chart. But if you were to go back a few more decades before the 50s, you would find a time when that actually happened. But what I want to talk about more specifically is what are the ramifications of this, and there's certainly different ways to look at it. Okay, there's sort of the glass half full approach and the glass half empty approach. Depends on kind of who you are and I guess what your bias is. But one way to look at this is we're going to just go to look at the year-over-year percentage change. And you'll see that it's at negative 4.63%, meaning the money supply is almost 5% less now than it was a year ago at this time, almost 5% less. If you look at it where it was last month, it was 3.95% less. Before that, 2.29. Before that, negative 0.887, right? So we've been getting increasingly negative, okay? The money supply has been contracting. Now, there has been some confusion on how do you read these charts. You might look at this chart and think that if it's going down, like it was, say, over here in the 80s, You might look at that and say that the money supply is contracting, but that is not true. This is the derivative, right? It's a rate of change. It's like, think about it this way. If this number is positive, then it's expanding. It might be expanding at a slower pace, but it's still expanding. Think about if you had, real GDP come in one quarter at say 3%, and then the next quarter was at 2%. You wouldn't say that the economy is contracting just because it only grew at 2%. If it grew at 3% the previous quarter, you would say, no, it's still expanding. It's just the rate at which it expands is slowing down. It's the same thing with inflation that I think a lot of people get confused about. There's a difference between disinflation and deflation. Inflation is coming down in many sectors, so we're seeing disinflation, but just because it goes from 8% year over year to 5% year over year doesn't mean that we're in a period of deflation. The prices of goods and services are still generally going up. They're just going up slower than they previously were. Okay, so we need to understand that. So if the rate of change is going down, as long as it's still above zero, it still is expansionary, right? Like it still is, we're in a phase of expansion. Okay, if it's below zero, if you see the year over year percentage changes below zero, then we're in contraction. This is a year over year. Okay, now there's other ways you can look at it. I mean, you could look at quarter over quarter and see some different trends. I mean, there are definitely very brief periods. Like you can see in 1992, there was a period quarter over quarter where it dipped slightly negative. And again, in 1993, where it dipped slightly negative. And then you can see right here in January of 2004, a quarter over quarter, slightly negative as well. Maybe, no, not even here. So looking at it quarter over quarter, there's a few times where it dipped very, very slightly negative, but it was not a sustained move in any way. I mean, this has been going quarter over quarter for a while now. Okay, so clearly this one is an outlier compared to these. And when you look at it on a year over year basis, there's no contraction going on. Okay, it's, you could say that, this is just noise quarter over quarter. It's just noise. And the more sustained trend is more so captured in the year over year percentage change. It helps to reduce some of the noise. So in this case, right, if you're looking at it from the early 80s until say the mid 90s, you might instinctually look at this and say, well, M2 is contracting, but that's not actually true. It's still going up. It's just going up at a slower pace. And if you think about it, we can go look at the sort of just the raw data. I mean, you can see it clearly, right? In the 1980s through the 90s, I mean, M2 is going up. It's just at various points, the rate at which it's going up is slowing down, but it's still in expansion. Right now, it's not an expansion. It's in contraction. Okay, so you can look at the year-over-year percentage change and see that it's at negative 4.63%. Now let's look at the quarter over quarter again, just to sort of see what direction it is. It's trending at least recently. And you can see recently quarter over quarter, it's getting increasingly negative, right? So the rate at which the money supply is dropping has been increasing quarter over quarter, more or less. And so that's something to consider. But if you just think about it in general, right? Like if asset prices go up when money is printed, you would sort of expect there to be a headwind when money is sort of destroyed. But there's also a glass half full approach to this as well. And that's to say, well, if we switch this over to a logarithmic scale, you might say, well, why switch to a log scale? When you're dealing with something like, something that's spanning several orders of magnitude, like the money supply and stuff of that nature, then, looking at it at a log scale makes sense. And you can see this trend emerge. If you look over the last, several decades, there's a pretty well-defined trend in the money supply. And it wasn't until March of 2020 that it really expanded upward. You can see that it expanded from around 15 trillion all the way to over 21 trillion. So we essentially added 6 trillion into the system in a relatively short period of time. Now, had this not occurred and we had just stayed on trend, we probably would be closer to maybe like 19 trillion or so by this point. So the fact that it's still well above trend, you could argue, an optimist might say, well, that gives us some wiggle room, right? We're just trying to get back to trend. And I think the economy it sort of recognizes that, right? I mean, and we've talked about this before as well, right? Like when you look at job openings, there's this idea of let's just get back to trend. One of the reasons the labor market hasn't softened up is it's not because people haven't been getting laid off. A lot of people have been laid off. But it's just that when you look at things like job openings for various sectors, let's just look at total non-farm, there's a trend here as well. And we're still technically above trend. It's coming down, but it's above trend. And so that's, I think, one of the reasons why it's important to consider, well, what was the previous trend? And where are we in relation to it? So in this instance, we're still above trend, right? We are coming back down, but there's still plenty of wiggle room for us to come back down and get back to trend and then start trending back up again. And hopefully between now and then, inflation comes back down to earth so that we can have another phase of economic expansion. But there's another way to look at this as well, which I think it's important, and it's not a way we've looked at it, I believe, not on this channel anyways, although I'm sure some people have covered it, and that's to adjust for inflation, okay? So to recap, when you look at the money supply, it generally goes up. When you look at it year over year, you can see that there's only one phase of sustained contraction in the last, 60 years or so. You'd have to go back a few more decades to find a period where the month over or the year over year money supply change was negative. Okay, you'd have to go back a few more decades. So that's one thing to consider. But when you adjust for inflation, there's a completely different story that can be told. Okay, so now we're going to do that. Inflation adjusted, you can see it's false. Now we're going to click on true. Now it looks a little different, doesn't it? Now, this is not the only period where M2 has gone down, right? I mean, you can see that, it has gone down a lot when you adjust for inflation. But there's also periods over here during the 70s, which was also during an inflationary period, where adjusted for inflation, M2 was going down, okay? So let's look at that year over year percentage change. Negative 9%, negative 914% to be exact. So inflation adjusted, M2 is down over 9% year over year. When you don't adjust for inflation, it's only down 4.63% year over year. So clearly, right, inflation has had a pretty big impact here. And we know that. Headline inflation is around 5%. So this gives us something else to compare to in recent history. Again, if you were not to include inflation adjusted, you'd have to go back to say like a few more decades, like the 1920s, 30s, that sort of time frame. But when you adjust for inflation, there are periods that you can compare to, okay? Now, the first thing we'll note is that this is more negative than it's been on this chart, right? So there are periods where it's gone negative, but the furthest it's gone negative is maybe around -5, -6% in the early 1980s, okay? At least on the time frames that we have on this chart. A counterpoint is to say, well, that may be true, but we also just went more positive than we have on this chart as well. So what you're sort of seeing here is you're seeing things swing aggressively in one direction and then just as aggressively, more or less, going back in the other direction, okay? So rather than have just a normal period, it's just we printed a lot of money really quickly, and now a lot of that money's being taken back, okay? So negative 9.14% year over year percentage change. And if you look back at other times where it was like this, you can see here's an example in the early 1980s where you can see that it came down to about -6.5% or so. The market was, during this period, you could see that it was going into it. It trended down for a little while. We popped back up, had a correction, trended higher a little bit, and then we had, this longer bear market in the 1980s where it basically we had a double sort of like a double dip recession. We had one very brief recession. The market continued higher. And then like, oh, well, we actually do need to get inflation under control. So let's just induce another recession and get it under control. And then you can see we had another bear market that essentially lasted from, say, early 1981, January 1981, February 1981, all the way until, say, July of 1982. So it lasted about, 18 months or something like that. And that came after, that bear market came after the money supply year-over-year change started to go back up, right? It was after that period. And that's not the only thing we compare to. If you compare to, say, 1973, you can see that it went negative. During that period, we were already in a bear market, and we continued that bear market, and that bear market essentially lasted until this turned back up, right? And it wasn't really until this turned back up that the S&Ps turned back up in a sustained way. And then there's one more example here where it went down to about negative 4% or so. And you can see in this case, the market, by the time it turned negative, we were already in a bear market. And the bear market continued until just after the year-over-year percentage change started to go up, right? So year-over-year percentage change of M2 money supply, inflation adjusted, started to go back up here. So it was still negative, right? It was still negative, but it was getting less negative, right? So it was still contraction, but the contraction wasn't as bad. We were trending in the right direction. And the market continued to go down for a little bit longer. And then once this trend became, sustained, you can see that the S&P started to really recover, okay? Now there's another period here and you can see in like 1989, and 1990, where it went slightly negative, like negative 2% or so during that period. The stock market, so it first rallied for a little bit, and then in September 1989, it basically just went flat until February of 1991. So about 18 months or so where the market was just relatively flat during this period. But then you can see that it was slightly negative, between 1% to 2%, and the market just sort of slowly grinded higher for a couple of years. Okay, so where are we here, right? I mean, like, there's not really a great spot to compare, at least not going back to, say, like the late 1950s. The times that appear the most similar to this would, of course, be the 1970s. But two of those examples, you can see that the S&P was already in a bear market, and the bear market did not really finalize until the year-over-year percentage change on the money supply, M2, was starting to become less negative. And then the last one, again in early 1980, the market was sort of trending up into this negative period, but then eventually, once it started to become less negative, then you can see we started another bear market that lasted, basically again from early 1981 until about August of 1982. So again, about 18 months or so. So, of course, when you're looking at it right now, it's important to consider how far will this go before it turns back around. Certainly, money being destroyed would be a headwind for risk assets. It doesn't mean that risk assets can't go up some. I mean, like, a lot of risk assets have gone up some. Some have put in new highs. Some have put in new lows as recently as this week, right? It all depends on what your bias is, right? If you look at, say, Nvidia, it's been doing pretty well, right? It just put in a new high. If you look at regional banks, they didn't get the memo that the economy is doing well, right? I mean, a lot of them have not been doing that well. And I mean, there's some other stocks that haven't been as well. So, and it really all depends on where you look, right? It really does depend on where you look. Crypto, I mean, Bitcoin has been doing fairly well this year, but it's also coming off the back of 2022, which was more or less down only. So one other way to look at this, right? And I don't want to go too much longer because I know these videos aren't really that appealing, but when you look at just sort of the inflation adjusted rate, or not rate of change, we're just looking at the raw data. So remember, non-inflation adjusted, log scale, you can see we're well above trend. Okay, we're still well above trend even though it's rolled over. If you adjust for inflation, I don't know that you can necessarily make the case that we're well above trend. You might say that we're back to trend right now, wouldn't you? If you were to just look at the screen. let's sort of draw an imaginary line through this right here. You would argue that we're already back to trend based on what we've currently seen. So I think the inherent risk is if this continues to go down and becomes increasingly negative like it has been. I mean, you're looking at, negative 0.4, negative 2.27, and negative 3, and and it just keeps getting worse and worse and worse. That is something that, could be a very strong headwind for risk assets. Now, you also should, I suppose, we should look at where it started to really start to roll over here. And it was in, December of 2021. And so, I mean, of course, when you compare April of 2023, you're comparing it to April of 2022. So I guess the downtrend had already started. But the point in all this is to say, like, when you don't adjust for inflation, it certainly seems like we're well above trend. So it doesn't look that bad. If you adjust for inflation, we're not that far above trend. Okay? So it all depends on how you look at this data. And I also suppose that it probably depends on what your bias is. I mean, if you're a bull, you're probably just going to say, well, non-inflation adjusted, we have plenty of room to go down, and it's still not a big deal. If you're a bear, you probably would say, well, we're kind of already at trend. And normally when the money supply contracts, that's going to be a headwind for risk assets, as we saw, about 90 years ago. So just something to think about. We'll see where M2 ends up in the coming months, and if it does turn back around. And if it does turn back around, then we'll start more so comparing to sort of these 3 prior times over here, where you can see it went pretty negative and then turned back around. Note that the furthest negative it went in the 1970s, 1980s was around negative 6.5%. And right now it's already at negative 9.14%. The biggest counterpoint, of course, is that before this negative 6.5% move, the highest it went back over here was 7.93%. Okay, the highest it went here was 24.75%, right? So it's not comparing the same thing, right? A lot of money was printed, and now they're trying to undo some of the mess they created because it created all this inflation that they're trying to get rid of. Okay, so. But hopefully this has been useful to you guys. I'm not going to keep you any longer. Thank you for tuning in. Make sure you subscribe. If you're not subscribed, give the video a thumbs up. And again, check out Into the Cryptoverse Premium at intothecryptoverse.com. See you guys next time. Bye.